Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Rosenkranz, portfolio manager with the Shelton Tactical Credit Fund, to discuss short and long-term rates, which bonds look compelling, and what it means for the consumer and economy. Jeff, it's great to have you with us. Welcome to Trade Talks.
Thanks so much for having me.
You got it. Let's start with some macro here. Is a soft landing still possible, or is a hard landing inevitable at this point?
It's going to be really, really tough to achieve a soft landing. The Fed really is terrified of inflation becoming entrenched. And so they're going to err on the side of overdoing it. And the problem is their policies operate with such a lag that by the time it's clear that inflation's coming down, they'll have already done too much. And so even if they correct at that point in time, it's still going to be pretty hard to achieve a nice soft landing.
And Jeff, it also makes it challenging to forecast when a hard landing is on the horizon.
It certainly does. I think even, they have all of the information at their disposal, and their forecasting is still less than ideal. And so even people with all of the information at their disposal find it challenging. And so we're not going to know, unfortunately, until we're through it and looking back.
Let's talk about interest rates, particularly short-term rates. Do you think short-term rates will go any higher?
I do. I think they have to. I think they need to probably go another 150 basis points higher or so to continue to keep financial conditions tight and make sure that inflation is killed off once and for all. The alternative is just much, much more challenging to try and kill it off a second time once it's already become entrenched.
And if we think about long-term rates, do you think they're going to push higher, or have they potentially peaked?
I think they're in or around a peak, or much closer to peaking than short-term rates. Remember, long-term rates reflect expectations over a longer period of time. And even if we think it's going to take a year or two to bring down inflation, that still leaves plenty of time over, let's say, a 10-year bond's life to achieve lower rates. So we do think longer term rates are in or around a peak, and at some point next year are going to start to head lower.
And do you think bond yields are attractive at their current levels? And which, if you do, which bonds do you find compelling?
We do. There are a number of areas of the bond market we do think are compelling at this time. I think it's important to stay up in quality, to identify bonds and borrowers who are going to be resilient through a hard landing. And so we like investment grade corporate bonds, double B rated high yield corporate bonds, and investment grade municipal bonds, longer term in nature, but again, sticking to resilient, high quality bonds at this point in time. No need to reach down the credit spectrum to be a hero and chase additional risk.
So, Jeff, when we put all this into perspective, and we mentioned at the top that it makes it forecasting challenging, this particular environment, what do you think this means for the consumer and then, of course, for the economy? I think part of the challenge is that investors have to remember that the economy is different than the market and vice versa, and that these policies do take time to play out. Just because you raise rates doesn't mean it corrects itself the following day. So when you think about the consumer, when you think about economic prospects a little bit longer term, what are your thoughts there?
It's going to be a tough time for the consumer. Higher interest rates affects so many different aspects of the daily economy, and they're purchasing houses, cars, large appliances. So it's going to be a tough time. At the same time, they're seeing their wealth, the effect of wealth destruction in asset prices. And so the double whammy. And then on top of that, everything that they're trying to buy on a daily basis, it's more expensive. And so until we see inflation starting to come down, it's going to be a tough time. Their savings have been depleted. They were actually doing pretty well during the pandemic because of all the stimulus. A lot of that's run out. And so, again, it's a tough time. And the last piece of this is that the Fed's going to push unemployment higher. They have to. And so the job market is also going to soften up a little bit, although it should remain relatively strong by historical standards. So tough time for the consumer, and certainly the economy is in for a rough stretch here. But again, the Federal Reserve if they overcorrect and push us into a hard landing economy, at least they understand what it would take to correct out of that and to bring an economy out of a recession. At least there is a playbook for that in terms of cutting rates. The flip side is if inflation becomes entrenched and they don't conquer it this time around, the playbook for trying to bring down stubbornly high inflation is just much, much more uncertain. So again, that's why we think we are headed for a bit of a tough time, and we just have to get through it.
Well, I mean, and to your point about a playbook, is there really a playbook with this? Because, just 2 years ago, we had an unprecedented amount of liquidity flushed into the system. To your point, stimulus checks, historically low interest rates, and, you flip the calendar 2 years forward, and it's a complete 360 with the strategy that the Fed has taken. And of course, you don't expect a pandemic to happen with every business cycle. So it's almost like is there really a playbook?
Not really. No, I mean, there certainly wasn't a playbook for a pandemic economy. And so they did the best they could. They were trying to avoid the catastrophic outcome of just runaway unemployment and massive failures across the board. And they actually achieved that objective, right? The economy remained resilient through the pandemic. There wasn't, sort of catastrophe and large scale business failures. The consumer held in pretty well. So mission accomplished there, but coming out of it, as you mentioned, it brought us another series of problems. And so now we're having to deal with that. And so, laying blame isn't really productive. Just it is what it is. And now we do our best to get through it and bring down inflation because the alternative is if it becomes entrenched, it's just so much more problematic.
Yeah. All right, Jeff, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.